What is Forex? Forex stands for foreign exchange. It is basically the global financial market that allows one to trade currencies. So if you think that one currency will be stronger versus the other and you ended up being correct, you can make a profit. If you are wrong, you lose money. So we are essentially speculating the foreign exchange rate between currencies. Still don't get it? Let me give you a live example. Let's say that I traveled from Singapore to the United States of America. Since I cannot use Singapore dollars to purchase stuff in USA, I have to convert that money that I have into US dollar at a currency exchange booth. So I went up to the currency exchange booth at the airport, and there's this big screen displaying different exchange rates for different currencies. So an exchange rate is the relative price of two currencies from two different countries. So right now the exchange rate is basically 1 Singapore dollar equal to 0.73 US dollar. So if I convert $1,000, I will only get 730 US dollars. When I exchange Singapore dollars to the US dollars, I'm essentially participating in the Forex market because I've exchanged one currency for another. Or in Forex trading terms, I have sold Singapore dollar and bought US dollar. So a month later, when I decided to fly back to Singapore, I went to the booth again so I can exchange my money back to Singapore dollar. But this time, I noticed the exchange rate has changed. It is now 1 SGD equal to 0.75 USD. Is these changes in the exchange rate that allows you to make money in the Forex market? So these exchange rates fluctuate every single day. By trading the Forex market, we are essentially betting on the strength of the currency or the economy of a country, which both is like kind of related, because if the country has a good economy, the currency is gonna increase in value. So we basically bet on these things based on things like technical analysis and fundamental analysis, which I'm gonna get into during the next few lessons. So Forex markets are always quoted in pairs. An example would be Euro USD, which means that Euro compared to the United States dollar. So right now, price of Euro USD is at 1.12. This means that 1 Euro is equal to 1.12 US dollar. So if you think that Euro's economy and currency will rise compared to USD, you buy. And if you think the opposite, you sell. If you think USD's economy and currency will rise compared to Euro, you sell. Because if USD goes up, that means Euro goes down. So you buy or sell based on the first currency in the pair, which in this case is Euro. So who trades the Forex market, or essentially who is participating in the Forex market? Firstly, we have the big banks. There are basically people like JP Morgan, all the investment banks who trades a lot of money, like billions of dollars, hedge funds, all of this stuff, right? Followed by large commercial companies. Some companies, they might have a lot of cash reserve, so they might want to enter the Forex market, right? Thirdly is followed by central banks and government. Central banks are basically the people that kind of regulate the money supply and demand in a country. And then followed by retail traders, which is us. So how do you make money in Forex? So an example is here on the screen right now. Let's say an example, Euro USD is at 1.12000 right now. So if it increased to 1.12100 and you went in for a buy, and the lot size that you use is one lot size, you will have made a profit of $100. We're going to discuss further on all these, like how do we count the profits and stuff, and like lot size, all these complicated terms later on this lesson. But right now, this is what you need to know on how to make money in Forex. So another example, let's say same scenario, but this time you use a smaller lot size, a smaller position size. You use 0.5 instead. So this time your profits will be $50. There's a typo right there, but basically your profits will be half. It'll be $50.